It's now time for Global Insight, where we speak to experts from around the world on issues making headlines. Luna's crash last month sent shockwaves across the crypto market as its sister stablecoin terraUSD depegged from the dollar and eventually fell from $119 at its highest point by 100%. In the wake of its crash that wiped out $45 billion across the two exchanges, around 280,000 South Koreans were affected, and the government and politicians have been jointly discussing measures on how to regulate the market. Well, a second round of talks on Monday at the National Assembly, attended by finance officials and 5 major virtual asset exchanges, produced a consensus on adopting a self-regulating protocol. But can the market be regulated? And moreover, can the broken trust in decentralized finance ever be recovered? To discuss this, we're joined today by SONG Soo-young, Professor at the College of Business and Economics at Chung-Ang University in Seoul, and Omid Malekan, Adjunct Professor at Columbia Business School. A very warm welcome to you both. And well, Professor Song, it's lovely to have you on our show. Looks like your video has momentarily stopped a bit, but I believe your audio is working fine. So, well, thank you for joining us this morning. And my first question to you, actually, Professor Song. So, the party government meeting on Monday, it was aimed at setting autonomous or self-regulating rules for trading virtual assets, with the major crypto exchanges here in the country forming consultative bodies that would set more stringent standards on them issuing and also scrapping coins from their establishments. But it all sounds well and good, but there is still some skepticism, though, that because these measures are perhaps non-binding, whether they're going to work or not in terms of regulating the market and protecting investors from the very high risk that these virtual assets have. So what are your thoughts on the developments that we saw yesterday?
Yeah, so far, Korean government has tried to establish some kind of meaningful regulations over the virtual assets. The virtual assets are defined as some digital instruments which could be traded and sold to the general investors. So far, the issue was in the United States, the SEC actually tried to regard those cryptocurrencies and actually the stable coins as some securities, but actually they failed to win against stable coins in the last the verdict. So recently they tried to set up some rules against the stable coins, which passed some Howey test, which defines whether it is should be regarded as a securities or not. So I think currently the Korean government is wait and see how the situation is developed in the United States. And then also they are concerned about some repressed development of the digital assets in the market, in the economy. So that's because some younger generations are very interested in those areas, and those digital economies is regarded as some new way to develop the economy further in the future. So that's why the Korean government right now is a little bit take the posture wait and see.
And Professor Malekan, it's not just South Korea, but it's all over the world, really, that governments have been looking to regulate the market. And, well, how does consumer protection for decentralized finance products really differ from the protections offered by traditional banks?
It differs in a couple of ways. One is that in proper DeFi solutions, there is no human beings making the kind of decisions that bankers do. The decisions are executed by code, which means that in an ideal design, you can actually build much more reliable financial solutions. because it's easier to regulate code than it is to regulate people. It's just that governments and regulators need to become a bit more sophisticated on how the technology works and what some of these solutions are trying to do, after which it should be actually fairly straightforward for them to develop rules that say, well, if you're going to develop DeFi code that makes decisions on, say, borrowing and lending, here are the parameters that we consider acceptable. The other feature of DeFi that is unique when you compare it to traditional financial services is that a lot of what happens is transparent in a way that, say, your local bank is not. So, for example, a banking regulator is always concerned to make sure that a bank or a fintech is not taking too much risk with customer assets and doing what they're supposed to. In traditional finance, the regulator has to rely on information provided by the company itself to do enforcement. But in DeFi, what they can do is go on the public blockchain, see where the assets are, see where the risk lies, and then quickly make a determination whether the solution is doing something that it should not be doing.
And Professor Song, well, there's been a lot of questions around the stability of stablecoin, really. And an influential lawmaker here, An Cho-soo, he suggested that the term stablecoin itself was problematic. So do you think the stablecoin mechanism still works?
Stablecoins are the cryptocurrencies which is pegged or tied to that of some another currency or commodity or financial instrument. So stablecoin works as some mechanism that is expected to stabilize the volatility of some cryptocurrency such as Bitcoin, or because the stablecoin itself actually works as the mechanism behind the stablecoin is very similar to the exchange-traded fund, which is provided by some reliable securities companies in the financial market, and the sponsor maintained a certain values that has guaranteed the value of the ETF itself. The problem is in this stable coin, they are not required to maintain a certain level of the values to guarantee the values of these stable coin itself. That causes a serious problem. So to that regard, I think the mechanism behind is maybe working and maybe may have some positive aspects for the virtual assets. However, it is very vulnerable to the change of the underlying asset value, and without maintaining the value of underlying asset, that causes a serious problem. So that is clearly shown in the case of the collapse of Luna and Terra, what has been very prevalent, I think, for the coming periods.
And Professor Song, what was quite interesting was that An Cho-soo, while he did criticize the fall of Luna, he also criticized the previous government's rather reluctant approach to virtual currencies. How does this administration differ from the former Moon administration when it comes to virtual assets?
Yeah, actually, as I mentioned earlier, because even in the United States, actually, the SEC has failed to win against some indictment against some stablecoin companies, because virtual currency such as Bitcoin does not pass the Howey test, which defines whether it is an investment contract or not. However, these stablecoin, they have made some public announcement that they are going to use and receive some payment and fee. So that could imply that these stable coins could pass the Howey test, which determines whether it is investment contract or not. So as long as they are judged as some investment contract, they must register as securities in the SEC. So that is that actually violates those the stable coin providers violate the law. So that could then the SEC has they could impose some kind of some fines and fee, some kind of taxation over those stable coins. So I think in the previous government, clearly, because they are not at all very assured of whether this should be the stable coins should be treated as some investment contract. Even the U.S. SEC was not assured of the characteristic and the features of stablecoin. So still, it is up to some judgment by the not by the producer or provider of stablecoin, but by the lawyers in the Supreme Court will determine whether the stablecoin should be treated as securities or not.
And Professor Malekan, now, in the months leading up to Luna's crash, there were questions around the stability of terraUSD as a stablecoin. And while the founder of Terra has been known for his sort of flary sort of comments, his interesting kind of comments that he makes, particularly towards those who question him. And well, in January, when he was asked how the Anchor protocol would continue to guarantee a 20% interest rate, he answered, "Your mum, obviously." And well, why was Anchor unsustainable? And do you think that the trust in decentralized finance has been broken for good due to this crash?
The 20% Anchor yield was heavily subsidized by Terraform Labs, the company that built the Terra blockchain and issued the UST stablecoin. And it was so high, and the size of UST grew to be so much that they were spending millions and millions of dollars a month to maintain the subsidy. So it was only a matter of time until they would run out of money. So it was a unnatural economic arrangement, which may have actually contributed to the collapse of the whole thing, because the algorithmic stablecoin model that they were trying has a questionable economic design. There are many experts within the crypto industry who predicted that it would eventually fail. Every previous attempt to implement a similar model to a stablecoin had also failed. So it was something of a confidence game. And because of the 20% yield, UST grew very, very quickly. And that rapid growth exposed the underlying problems with the design and led to the eventual collapse. All of that does hurt the reputation of crypto and DeFi to a certain extent. I think it's important to realize that this was a fairly experimental project. There are other stablecoins and DeFi solutions that have been around for years. They are based on much more sound and conservative economic models, and they have worked fine. Even in the midst of the current severe decline in crypto prices in the last 24 hours that you reported on earlier, the other stablecoins and the more sort of blue chip DeFi solutions have operated perfectly well. So hopefully that will help restore confidence.
And Professor Malekan, now, the founder of Terra, he tried relaunching Luna, of course, Luna 2.0. But do you think that the Luna and Terra mechanism still works? Do you think stablecoins can really offer investors some level of stability?
So the new Luna actually does not have a stablecoin anymore. They did away with the UST part, which was the far more radical experimental aspect of the original project, which then begs the question of what is the point of it? If Terra 2.0, as they call it, is just another blockchain that developers could build on top of, well, there are already many of those, the biggest one being Ethereum. As for stablecoins in general, I think this is the end of that particular approach to stability, the algorithmic model. The several other projects that implemented have all seen their coins lose their peg to the dollar very recently. However, the other approach that my colleague here was talking about earlier, to building stability, which is designed, as he eloquently put it, like sort of like an ETF, where you have someone who's responsible for maintaining the peg by keeping sufficient reserves. In this case, it's usually the issuer keeps the cash reserves in the banking system or holds liquid, safe securities like government bonds. That model has been around for 7-8 years now, and it generally works. And it's starting to get regulated, including, as was mentioned earlier, in places like the US. So as the issuers become more regulated, I think users will trust their stablecoins even more, and they will continue to grow.
Well, I'm afraid due to time, this is where we'll have to leave the interview today. That was Chung Soo-young, Professor at the College of Business and Economics at Chung-Ang University, and Omid Malekan, Adjunct Professor at Columbia Business School, joining us from New York. Thank you both so much for your time today.
Yeah, thank you. Pleasure.